choose 2 timeframes. Stop going to the daily, weekly, monthly, hourly, 4 hour. Stop doing that. Okay, choose one time frame to find the structure and the elements, and another time frame to analyze the structure. If you want to trade all the time frames, just do it separately. I'm sorry, this is not popular or it's not what people are doing, but I find it way more easy. I find it way easier and comfortable to trade with 2 timeframes. I don't have to stress about if I'm in premium in 4 hour, in discount in 1 hour, and then do I buy, do I sell, where do I put? It is confusing for me. Okay, perhaps I'm a noob, I'm stupid, I have a little brain, I cannot understand, but the chances are that this is going to take you less time to apply if you choose only 2 timeframes. Then choose your trading session. If you cannot be awake every session, there is no point and with taking trades in backtesting or finding examples in a session you cannot trade. And then choose your trading elements. I advise to use one element at a time. It's gonna be painful to frame an impulse, to wait for a reaction, and you are waiting for the order block and it reacts in the fair value gap. Oh, that's so sad. It's fucking okay. Okay, you're not gonna get it right all the time. If your thing is the fair value gap, then go hunt in the fair value gaps in your higher time frame. They are aligned to structure. They are in the premium or discount zone. Then you can do another model with the order block, okay? Or you can do a model with both combined. But honestly, you should start by one. And I know you want to get a lot of trades, and I know you want to be in every move, in every reaction. You want to get everything, but this is not going to help you. There are a lot of people studying ICT. He has a lot of followers, and still people can't be consistent with the concepts. Guess why? Because there are too many possible models, too many possible support and resistance levels, too many types of entries, too many types of confirmations, and people want to trade everything because they don't want to miss out anything. Okay, so after that, just find 100 examples of where price went to the premium or discounted zone and gave you the reaction you were waiting for, just in the higher time frame. Then observe the lower time frame reactions. You don't know if you're going to enter if price does a, I don't know, market structure shift, or if price just shows you a fair value gap, or if price validate an opposite order block. You don't know what's going to be for you. You don't know how many times it repeats, which one is the best one, which one works better, which one you like it more. So just observe the lower time frame reactions, and once you choose one or two or three or whatever you're going to do, one should be ideal, reaction in the higher time frame element, just backtest that 100 times, that specific entry. Forget about if you, for example, if you chose fair value gaps, don't try to trade order blocks. Don't suffer because price just went a little above and it reacted in the order block. Don't be lazy and don't be cringy. Don't be petty. You will have time to do another backtesting and trading with the order blocks, entering in the order block, entering in the 50%, entering in the different ways. But you cannot get it all. Then I would suggest between backtesting, forward testing, demo, and live trading, aim for at least 100 identical trades. Identical, same trigger to enter, same higher time frame element. Now, which asset, right? Do you think that if you backtested in the Euro USD, will it work too in the pound, in the British pound? Will it work in the Aussie dollar? You know what? Nobody's gonna tell you. Or yeah, perhaps everyone is gonna tell you, yes, it works great everywhere, and it doesn't for you. Okay? So now is the part where you have to do the hard work. I hope this video was helpful. If not, let me know in the comments to know how can I improve it. And remember, this is only my personal view of ICT concepts. You can have a different view. You can believe that, I don't know, the CBDR deviations are the best thing to trade, buddy. But that's up to you.
Okay, sticking to our model, we used the Aussie dollar daily chart the last time, We're going to look at this same setup, and we're going to look at it in terms of refining it with lower risk. Now, I want you to look at this chart carefully because this is exactly the same chart you saw in the previous teaching. Now, I'm going to amplify on this, but it's important you understand the way the framework is here. You're going to see it's exactly the same thing, just brought down to a lower time frame chart. And we're actually going to do it in 2 scales lower. I want you to look at the fact that we have the higher time frame, 75.12 level relative to the daily chart. That's what this line is here, delineating the daily bullish order block. Notice we have an old low here, and price goes through that down into that higher time frame level. It's really important you see that, because not only is it just because we're going below old lows not enough to expect a reversal. Okay, we're not looking for that just because that's the case. We're looking for a higher time frame premise. Why should we expect there to be buying down below an old low? Because this daily chart level, 75.12, is an old bullish order block because banks have bought there before. So if we trade into that level again, okay, look at the framework here. We have a hourly chart with a low being violated down into a key support level relative to a daily time frame. We've noted obviously the buy stops above here, just like we did in the first teaching, and obviously the second area of buy stop. So we have upper level objectives framed on this trade. It's not a scalp. It's not a day trade. It's something that's going to give us a little bit more magnitude, okay, for objectives for hauling in pips. Now, obviously, we framed in the first teaching in this month's delivery of content, we looked at this down candle as the bullish order block, and we were looking at 75.42 as a long entry. And obviously, by doing that, we framed what a 20 pip stop. This is where our stop loss would be, which would be below the mean threshold of this down candle, which is a bullish order block. So what if you want to get a smaller stop in relative terms to 20 pips? And here's a more important thing. What if you want to be buying lower and offering yourself a lot less in terms of risk exposure? Well, that's going to require us going down into a 15-minute time frame. Everything here, look very closely. This is very close to what you saw on an hourly chart. We have an old low. Price trades down below that old low right into that key level, 75.12 level. Now this up here is the buy order that would be needed on an hourly chart, way up here. But what if we focus our attention down in this area here? What could we do with this information? Well, obviously the same thing's there. We have sell stops below an old low where buy orders can be paired up on the smart money side. And you see the market trades down into that level, 75.12, so we do have a turtle soup long setup. But we don't require the price to come all the way up here before we start buying. So how can we do this and reduce risk? Well, we can take the bullish order block here, the down candle, right off of that level. And why is this a bullish order block that's valuable and it's worth taking? Because this candle trades through it right here. And now we can focus on the midpoint of that candle up to its high. In that area, we could be a buyer. So we could be a buyer down here at 75.20, okay, and have a stop loss down here at 75.07. It should not go down to 75.07. If it's going to go higher, it should go up higher from where it's at now. By doing so, now we have a 17 pip stop loss, and look how much lower we are in relative terms to what we saw on the setup on the hourly chart, way closer to the key level of 75.12, and we're using a 15-minute time frame to do it. So looking at it in terms of even further reducing the risk, we can take this small little area in here and refine that same sample size of data, okay, and we're going to take a closer look into it. Okay, so we're zoomed in now on a 5-minute chart. All we're doing is looking at that same 75.12 level, okay, and we're refining the entry from 75.20. What can we do differently here? Well, let's take a look at what's going on inside this yellow area. Okay, we have price with another down candle as it hits that bullish order block, 75.12 on the daily chart. This down candle gets violated right here. So now we can start looking at this down candle from its open or high down to the midpoint, and we can be a buyer there. Or we can just simply say, okay, well, that's basically the 75.12 level. We'll just add the spread to it in terms of buying. That puts us in around 75.15. Our stop loss could still be down here at 75.07. That's less than 10 pips. Less than 10 pips on a buy.